watching All About Stocks on ET Now. This is the show that does your equity investment homework for you and tells you what stocks you should be investing in. Prakash Diwan is still with us on the show. Prakash, before I go across to the stocks you recommend to us this week, I want to bring up one that you recommended a couple of weeks ago. You talked about CAG India, and while you recommended to us, it was 288 with a target of 408 rupees. Now, that stock is at 354 right now. Would you still recommend buying it at this current price?
Certainly. In fact, if you realize, CAG has made some significant highs in the recent past, and what you see today is actually a price that it's moved down to. CAG, given its strength in terms of the collective strength that it has when it's expanded into some new fields, from the time we spoke, I think it's a great positive. Oil itself is likely to continue doing well, and that's a direct correlation with CAG. We've had certain issues with the test, implementation that we heard about in the budget. That's been a negative. But once people get over that and it's factored into the retail pricing, I don't think that should be an issue for CAG also. So CAG is a buy. You should buy it. In fact, the new target could be in the range of about 420, 425 for somebody looking at entering at this point.
Alright, a new target there for CAG, and Prakash telling us that it's still a buy because he believes that it will do well over the next 2 years. Let's move on now to his new pick for this week. He's brought to us MCX India. Take a look.
The Multi-Commodity Exchange of India, or the MCX, is the largest commodity exchange in India and also the first to list in the country. MCX enjoys an 88% market share and trades in crude oil and metals as well as agricultural commodities. The price band for the IPO was set between 860 to 1,032 rupees, and the issue was oversubscribed almost 54 times. The shares opened with a premium of 34% when it listed on the 9th of March and clocked 26% gains on its very first day of trade. Having won the lawsuit against SEBI, MCX now has the option of trading in equity as well as in the currency segment. But in spite of all the positive news surrounding the counter, it has corrected about 200 points since its listing. The company has a high level of product concentration, and any government regulations or bans may hit volumes significantly. Also, the highly competitive derivative sector the company operates in could also dampen profitability in the future.
Alright, so that was MCX India. Prakash, normally when we consider an IPO, there are two ways to figure out if the fundamentals of that company is strong. One is to take a look at the institutional subscription or the QIB subscription, and the other is to obviously look at the rating that it's been given. Now, this IPO was given a rating of 5 on 5, and we know that QIB was oversubscribed nearly 50 times. So, can we as retail investors take it for granted that this is a company with very, very strong fundamentals?
See, very valid question, because it's a business that's very unique of sorts. In fact, it's the first exchange that have got listed on our exchanges. And the exchange business is something that a lot of retail investors would take time to understand from the financial paradigm. And my sense is MCX has seen those fundamentals emerge so strongly in the last couple of years particularly. It had its initial share of capitalization issues and all, but once they've expanded, they've got the critical mass. The financials are also getting in place in a very, very healthy fashion. And the growth here on is not just linear, it could be actually empirical if they were to expand as they've planned into other markets, other geographies. And if that were to happen, new commodities getting added to its list, you have a growth which is much more than what an industry player could actually look at. So it's a proxy to the economy's growth, to the capital markets growth, and I certainly feel retail investors should take cognizance of the fact that it could eventually be not only a great dividend-paying company, it could also be a great capital appreciation opportunity.
We've seen the stock correct from its listing price, which was about 1,400. It's down to about 1,250 at this point. Would you say this is a good level to buy? Where do you expect it to correct any further from here, like the other IPOs we've seen over the last year, or do you think this is the point to buy?
No, I don't see any sort of a deeper correction from where we are. Primarily, if you notice, it's been consolidating in this zone with very decent volumes. It's not that it's lost, people have lost interest in trading on this stock. there is still accumulation happening from interested people. 1400 of course was a reaction that you would expect in an IPO of this scale and this size. Ever since we've seen the listing after 9th, the markets have been very choppy, and thanks to that it has lost some value. But I think this is a great time to buy into because the targets we are setting are much higher.
Prakash, tell us, for someone who gets in at this point with MCX, this is obviously a very long-term stock that we're talking about. Ideally, how long would you advise an investor to stay invested with a stock like MCX?
I don't think people should look at getting out of a company like this or a business like that. As long as it remains profitable, it remains into a leadership position, the financials are healthy, the margins are maintained, it could become a cash cow in the portfolio and start paying you dividends after a while, which would be very attractive also.
Alright, so Prakash's first recommendation is MCX. Remember, he did say that it's a long-term view and this is a good time to buy that stock. After the break, Prakash will tell us why he picks Indoco Remedies as another stock we should be investing in. We'll also answer that question about your Mahindra Satyam stocks. So stay tuned.